It's a rainy day here today in Boca Raton, Florida. Boca Raton. That means mouth of the rat. But doesn't it sound so much more elegant when you say Boca Raton? Anyway, today what I'm going to talk about is fees. Specifically, fees that investment advisors charge and how it impacts the amount of money that you have to enjoy your life with. Listen, there's absolutely no problem with paying fees if you're getting tremendous value for them. However, most investment advisors don't come close to beating their averages. Now, they may show you that they're beating the S&P 500 or something like that, but what I'm going to show you later is in my book how they're doing that. It's very simple. It takes about 5 minutes a year to do, and you may be paying fees for the whole year for this simple procedure. After you see how much these fees are going to cost you, I'm going to give you a resource that you can look at so that when you're questioning, why the hell am I paying this much, that you can have a different system that you could use that'll give you the best of both worlds, give you all the upside potential and set an absolute maximum on how much you can lose in any given year, and it'll only take you about 15 minutes a year to manage that. Save the fees. So let's look at the fees. How much are you paying and how much is it costing you and your household to pay for investment advice? I'm utilizing a calculator from a planning program that I use with my clients to illustrate this point. I'm assuming that a person is 25 years old and going to retire at age 65. Then I'm going to take this out in retirement, have this individual taking roughly 4% of their net worth out as income, increasing at 3%. Okay, so let's get started. 25 to 35, I'm going to increase contributions here. I'm going to say we're going to put in $3,000 at age 25. We're going to increase that by 3% to age 65. What that's going to do is it's going to have $226,106 of total contributions to the retirement account. Now what I'm going to do is I'm going to assume a 10% return. The reason for 10% is because the S&P 500 has averaged 10% over the last 30 years. If we do this, what we're going to have is 1.979, $277 million. So $1.97 million of accumulation for this individual. That could be a pretty good retirement. But now let's go to the costs. Now I'm going to avoid all the federal taxes, state taxes, and inflation, and right now just concentrate on the fee. And I'm going to assume that in that period of time from 25 years old to 65 years old, this individual is going to pay an average of 2.5% of their account balance. The reason I'm choosing 2.5% is this is the typical fee that I see in investment statements of my clients that come in, especially those under $1 million. Now you're going to say, yeah, but this person's $1.97 million. Not if they pay a fee. So watch what happens when I charge and change this and have the fee coming out during those 40 years. The amount that they've actually accumulated drops almost by 50%. It actually drops $982,000. The total amount of fees that came out were $265,000. But because that money was removed from the account and no longer able to grow, it shrank the account by close to $1 million. This is known as the opportunity cost. And I want to make a note that the total amount of fees that were taken out during this time is more than the contributions that this individual made of $226,000. Now let's look at retirement. So now you've made it to retirement and you have $997,000. We're going to assume that right now you're going to continue to get 10% return on your money with no distributions. Well, that would take you to $10.8 million that you'd have the day you die if you live to age 100. If we start charging that 2.5% fee, then you would be paying $1.59 million in fees, and that would reduce the amount of money that you would have had by roughly half again. Now in retirement, most of the time what happens is people reduce the amount of risk. They don't have 100% of their money in stocks. Instead, they put half of their money in something like bonds, which are safer. But today, in 2017, when I'm making this video, bonds are only paying 3 to 4%. That means that If you're paying 2.5% on your portfolio, then the portion that's in bonds, the fee is actually eliminating anywhere from 50 to 90% of the return on up to half of your portfolio. Okay, well right now what I want to do is I'm going to actually change this from 10% to a 7% return to reflect a portfolio that is half in bonds. Now what that does to you is it reduces the amount of money that you have to 2.8 million. Less return, less money. But what we're going to do now is we're going to actually take an income starting at age 65 of $40,000 a year. And we're also going to increase that by 3% every year. When we do this, you're going to see that you're only going to have $319,000 at age 90 if you lived to 90. As a matter of fact, if you lived to age 100 under this scenario, you're actually going to run out of money. And I'm going to illustrate this and show you where this comes. In this example, you'll actually run out of money, in this case, at age 94. If we eliminate the fee and stop charging it and still take out the same amount of money, even at age 94, you're still going to have well over $2 million. That's how big that fee is and an impact on how you're going to retire successfully. Now you might think that having somebody watching your money is somehow going to protect you if the market collapses one day. Well, that's not necessarily true. Or you may think that they have some special extraordinary ability to be able to pick stocks and be able to beat the market. That's not true either. Actually, all they're doing is using what's called an asset allocation, which you can look up online through any one of these investment sites, mutual fund companies, to see what their allocation is. You can duplicate that by buying low-cost ETFs and rebalance periodically. Takes you about 15 minutes, would cost you about $60 a year, depending if you have $250,000 or $5 million. Probably isn't going to cost you too much more than that. And now you can do this yourself and keep that money. But you still have the risk of one day something happens and the market goes down, 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 down. After all, you are responsible and you're the one who's going to suffer if it does. But they always tell you in the investment world, you've got to stay the course. But of course, they have no liability if it does go down. They're just going to keep charging that fee. And their incentive is to keep you invested so that you are paying them their fee. So here's what I'm going to do. I'm going to invite you to download my book. The link is below here. I'll give you a different idea on what you can do. It takes another 10 minutes a year, but it makes sure that you can set an absolute maximum on how much you can lose in a given period of time while getting 100% of the game, and it's all contractually guaranteed. So go ahead, download the book, take a look at it. I give you why I think like this. You can agree or disagree, but it's going to be life-changing for you to know that you can keep your money, you can have the best of both worlds, and you can do it all spending just 10 to 15 minutes a year doing this. If you like this video, share it with your friends, let them see it, let them understand how much they could be saving if they invested on their own and how much those fees are actually costing them in their enjoyment of life. This is Kevin Winke. Thanks for watching. Till next time. Boca Raton.